Picture this. You've been sitting on the sidelines for 2 years watching interest rates climb higher and higher, making everything more expensive. Your mortgage payment would have been insane. Your car loan would have killed you. Even your credit card was charging you 25%. So you waited. You held off. You told yourself rates would come down eventually. Well, guess what? They're dropping. The Federal Reserve has been cutting rates, and we're finally seeing some relief. Not a lot, not back to the COVID lows, but enough that you need to pay attention, because if you play this right, you could save thousands of dollars this year. Maybe tens of thousands. But here's the thing. Most people will sit around and do nothing. They'll wait until rates drop even more. They'll miss the window. And by the time they finally act, rates might be climbing again. Don't be that person. So let's break down the 5 financial moves you need to make right now while rates are dropping. By the end, you'll know exactly what to do to take advantage of this moment before it's gone. Move. Number 1. Refinance your mortgage. First move, refinance your mortgage. If you bought a house in 2023 or 2024 when rates were at 7% or higher, this is your chance. Mortgage rates have dropped significantly. We're now seeing rates around 6% to 6.5% for a 30-year fixed mortgage. That's a full percentage point lower than where we were. Now I know what you're thinking. 1% doesn't sound like much. But let me show you the math. Let's say you have a $500,000 mortgage at 7%. Your monthly payment is about $3,327. If you refinance to 5.75%, your payment drops to $2,786. That's $541 a month. Over a year, that's $6,492 back in your pocket, just for making a phone call and filling out some paperwork. And here's the rule of thumb. If you can get a rate that's at least 1 full percentage point lower than what you have now, it's probably worth refinancing. Even after you pay closing costs, which usually run 2% to 6% of the loan amount, you'll break even within a year or two. After that, it's pure savings. And here's a pro tip. You don't have to refinance with your current lender. Shop around. Compare rates from multiple lenders. Some might offer better rates or lower fees. Some might waive closing costs if you stay with them. Do your homework. This isn't a decision you make in 5 minutes. If you bought your house before 2023 and you're sitting on a rate below 5%, don't refinance. You've got one of the best rates in history. Just write it out. But if you're stuck with a 6%, 7%, or even 8% rate from the past few years, this is your moment. Move number 2. Pay off high-interest debt. Second move. Pay off your high-interest debt. And I'm talking about credit cards, personal loans, anything with a double-digit interest rate. Because here's the deal. Even though interest rates are dropping, your credit card company isn't lowering your rate. They're still charging you 20%, 25%, sometimes even 30%. Let me put this in perspective. If you've got $10,000 in credit card debt at 25% interest and you're only making the minimum payment, you're paying about $208 a month. But here's the kicker. Only $42 of that is going toward the actual debt. The other $166 is pure interest. You're basically setting $2,000 a year on fire. Now, with rates dropping, you've got options. You could take out a personal loan at a lower rate and use it to pay off your credit cards. Personal loans right now are running anywhere from 8% to 15%, depending on your credit. That's still high, but it's way better than 25%. On that same $10,000 debt, if you consolidate it into a personal loan at 10%, you'd save hundreds, maybe thousands in interest. Or if you own a home, you could do a cash-out refinance or take out a home equity loan. Home equity loans are running around 7% to 9% right now. You'd use that money to pay off your credit cards, and suddenly your 25% debt becomes 8% debt. Your monthly payment drops, you pay less interest, and you free up cash flow. But here's the warning, the bottom line. High-interest debt is killing you. Every month you carry it, you're losing money. Use the dropping interest rate environment to refinance that debt into something cheaper. Then attack it aggressively. Get it paid off. Because once it's gone, that's money you can save, invest, or actually enjoy. Move number 3, lock in long-term financing. Third move, lock in long-term financing while rates are still relatively low. If you've been thinking about buying a car, upgrading equipment for your business, or making any big purchase that requires financing, now's the time. Auto loan rates are dropping. They're not back to where they were in 2020, but they're better than they were a year ago. If you've got decent credit, you can probably get an auto loan around 6% to 8% right now. A year ago, you were looking at 9% to 12%. That difference adds up over a 5-year loan. Let's say you're financing a $40,000 car. At 10% interest over 5 years, your monthly payment is about $850. At 7%, it's $792. That's $58 a month or $3,480 over the life of the loan. Not huge, but not nothing either. And here's the thing, if you wait and rates start climbing again, you'll kick yourself. Because once you lock in a rate, it's fixed for the life of the loan. If rates go up next year, you're protected. You're still paying 7% while everyone else is paying 10% or 12%. Same thing with business loans. If you're a small business owner and you need capital for expansion, equipment, inventory, whatever, borrow it now while rates are favorable. Commercial loan rates are starting to ease. They're still higher than consumer loans, but they're better than they were. And if your business needs financing to grow, don't wait for the perfect rate. Get the money you need, invest it in growth, and the returns will more than cover the interest. But be smart about this. Don't borrow money just because rates are lower. Only borrow if you actually need it and can afford the payments. Move number 4, refinance student loans. Fourth move, refinance your student loans. If you've got private student loans sitting at 8%, 10%, or even higher, you need to look into refinancing. With interest rates dropping, private lenders are offering better rates than they were a year ago. Now, let me be clear, if you've got federal student loans, don't refinance them into private loans. Federal loans come with protections, income-driven repayment plans, deferment options, potential forgiveness programs. Once you refinance federal loans into private loans, you lose all of that. So unless you're absolutely certain you'll never need those protections, leave your federal loans alone. But private student loans? Those are fair game. Let's say you've got $50,000 in private student loans at 9% interest. Your monthly payment is probably around $633 over 10 years. If you refinance to 6%, your payment drops to $555. That's $78 a month or $9,360 over the life of the loan. And the best part? Refinancing student loans is usually free. No closing costs, no origination fees. You just apply, get approved, and your new lender pays off your old loans. It's one of the easiest financial moves you can make. But you need good credit to get the best rates. If your credit score is below 650, you might not qualify for the lowest rates. In that case, work on improving your credit first, then refinance. Pay down some debt. Make all your payments on time, get your score up. Then apply. And shop around. Don't just go with the first lender that offers you a rate. Compare at least 3 or 4 lenders. They'll all give you slightly different rates and terms. Some might have variable rates that start lower but can go up. Some might have fixed rates that stay the same for the life of the loan. Figure out what works best for your situation. The key is to act now while rates are dropping. If you wait 6 months or a year, rates might be higher. You might miss your window. So if you've got high-interest private student loans, start the refinancing process today. Move number 5, invest in bonds or CDS. Fifth move, lock in high yields on bonds or CDS before they disappear. This one's counterintuitive, but hear me out. Interest rates are dropping. That's bad for savers because it means you'll earn less on your savings accounts and CDs. But right now, before rates drop too much, you can still lock in some pretty decent yields. Now, high-yield savings accounts are still paying around 4% to 5%. CDS are paying 4% to 5% for one-year terms, sometimes higher for longer terms. Those rates won't last. As the Fed continues cutting rates, those yields will drop. So if you've got cash sitting in a regular savings account earning 0.5%, move it to a high-yield savings account or a CD right now. Let's say you've got $20,000 in emergency savings If it's sitting in a regular savings account at 0.5%, you're earning $100 a year. If you move it to a high-yield savings account at 4.5%, you're earning $900 a year. That's an extra $800 just for moving your money to a different account. It takes 10 minutes. Or you could put that money in a CD. A 1-year CD at 4.5% locks in that rate for the full year. Even if interest rates drop to 2% next month, you're still earning 4.5% on your CD. The downside is you can't access the money without paying a penalty. But if it's money you don't need for a year or more, a CD is a smart move. And if you're more sophisticated with your investing, look at bonds. Treasury bonds, corporate bonds, municipal bonds. Bond yields are still relatively high right now compared to where they'll be if rates keep dropping. When rates fall, bond prices go up. So if you buy bonds now and rates drop, your bonds become more valuable. You can sell them for a profit or just hold them and collect the interest. So there you have it. 5 financial moves you need to make right now while interest rates are dropping. Refinance your mortgage if you're stuck with a high rate. Pay off high-interest debt by consolidating it into cheaper loans. Lock in long-term financing for cars or business needs before rates climb again. Refinance your private student loans to lower your monthly payments. And lock in high yields on savings, CDS, or bonds before they disappear. These moves aren't complicated. They don't require you to be a finance expert. They just require you to pay attention and take action. Because most people won't. They'll sit around, procrastinate, tell themselves they'll do it later. And later never comes. Or by the time they finally act, the opportunity is gone. Interest rates don't stay low forever. The Fed could pause cuts. Inflation could spike again. Economic conditions could change. And suddenly, rates are climbing back up. You'll have missed your window. So don't wait. Pick one of these moves and do it this week. Refinance your mortgage. Pay off your credit cards. Lock in a CD. Whatever makes the most sense for your situation, just do something. Because doing nothing is a choice. And it's the wrong choice. The window is open right now. Interest rates are dropping. This is your moment to save money, pay off debt, and set yourself up for a better financial future. Don't let it pass you by. Take action right now. Your future self will thank you.